It's not every day that a tiny market statistic makes my heart skip a beat. But here we are. A subtle pattern in Bitcoin's newest ETFs might be pointing to a massive rally and potentially a six-figure price. I know it sounds crazy. I almost brushed it off myself, yet the deeper I looked, the more it felt like a clue that something big is quietly brewing in the crypto world. So, let me share this story. It started on December 1st. I was browsing through some market data when I noticed that US spot Bitcoin ETFs had a net inflow of money again. In plain English, more money flowed into these Bitcoin funds than flowed out. That alone isn't unusual. It happens sometimes, but this was the fourth day in a row it happened. And here's the kicker. The net inflow on December 1st was about $370,000. Pocket change in the context of Bitcoin, right? But the amount wasn't what got me excited. It was the pattern. 4 consecutive days of positive inflows told me that a trend might be forming. Now, I'm a big believer that small clues can foreshadow big moves. A net inflow means overall investors put in more cash than they pulled out. Even though $370,000 is a drop in the bucket for Bitcoin, the fact that it kept happening day after day signaled to me that there's steady interest building among investors. It's like a heartbeat, faint but steady, indicating something alive and growing in the background. To understand why I found this so intriguing, let's break down that December 1st example a bit more. On that day, not all ETFs moved in unison. In fact, BlackRock's IBIT, which is the 800-pound gorilla of Bitcoin ETFs, saw a pretty big outflow. About $74 million left BlackRock's fund. That sounds bad, like investors were cashing out. But at the same time, Fidelity's Bitcoin fund, FBTC, gained $67 million, and Ark Invest's fund pulled in another $7.4 million. Add those up, and they almost perfectly offset BlackRock's outflow, leaving that tiny net positive of $370,000. In other words, one big player was taking profits or reallocating, but others were eagerly buying in. This kind of tug of war painted a nuanced picture. It wasn't just a one-sided frenzy of buying. Instead, some investors were trimming positions, maybe locking in profits given Bitcoin had been strong lately, while others saw the dip as an opportunity to jump in. The result, a stalemate on the surface, hence the small net inflow, but one that still leaned slightly to the buy side, and that lean continued for 4 days straight. It's a bit like two teams playing tug of war. If neither side is dominating, but one side inches forward consistently each day, you start betting that team might eventually pull the other into the mud. By this point, I was pretty curious. Was this streak just a fluke or part of a bigger shift? Well, the very next day, December 2nd, I checked the data again. Lo and behold, a 5th consecutive day of inflows was on the books. And this time the net inflow wasn't small peanuts. Roughly $58.5 million of new money came in on December 2nd. Even more interesting, BlackRock's fund, which had seen that large outflow before, got a massive $120 million influx on December 2nd. It's almost as if whatever big seller caused the previous day's outflow had finished, and now big buyers were piling in. 5 days in a row of positive net inflows that hadn't happened before in the short history of these US spot Bitcoin ETFs. It felt like a quiet momentum was building under the surface. Now, around the same time, if you looked at Bitcoin's price chart, you'd see something that made a lot of heads turn. Bitcoin's price, which had briefly pulled back to about $84,000, suddenly jumped nearly 7% and was trading around $93,000 in early December. 7% move for BTC isn't unheard of. Volatility is part of the game, but seeing it bounce that hard while these ETF inflows were stacking up caught my attention. It was like the price and the ETF data were singing in harmony, maybe not a perfect duet, but definitely the same tune. The broader crypto market was recovering as well, but Bitcoin was leading the charge. This is where speculation started to run wild, as it always does in crypto. People began asking, are these steady ETF inflows actually helping drive the price up? And if they continue, how high could this go? It didn't take long for some bullish predictions to emerge. In fact, I came across one that really fired me up: $120,000 Bitcoin in December. Yes, you read that right. Some analysts are openly talking about BTC potentially hitting $120,000 in the near term if this streak of institutional buying continues. One of the analysts I follow, Martinez, pointed out something important on the charts. He noted that Bitcoin's next major technical resistance level looks to be around $99,000. That's the price ceiling that could be hard to crack. But if BTC manages to break above $99,000, Ali's analysis suggests the next target zone might be around $122,000. Basically, above 99K, there isn't much historical resistance until you get to the low hundreds, so Bitcoin could fly pretty quickly into the 120K range. Hearing that, I was like, whoa. It put a number to the vague optimism floating around. And then there's another guy, Gert van Lagen, who highlighted a rare bullish signal in the market's volatility data. He pointed out that the Bollinger Band width, a technical measure of volatility, dropped below a certain threshold. He said below 100 for the TA geeks out there. Why does that matter? Historically, when volatility gets that low for Bitcoin, it's like the calm before a storm. Often a parabolic move follows. According to him, every time we've seen this setup in the past, Bitcoin went on to a significant rally. His chart even hinted at the possibility of BTC reaching around $140,000 if history rhymes. Now, that doesn't mean it's guaranteed, but it's another data point feeding the bullish sentiment. Hearing $120,000 or $140,000 targets tossed around, I had to take a step back for a second. It's thrilling, sure, but haven't we all seen lofty predictions before? This is the moment in the story where the seasoned crypto investor in me starts tapping me on the shoulder, reminding me not to get carried away. We need to talk about risks and reality checks. In fact, this is probably a good time for a quick disclaimer before we go any further. This might shock you, but I'm not a financial advisor and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. Always do your own research and consult a qualified professional. Your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. This video is for entertainment and educational purposes only. Alright, with that said, let's continue, because despite all the hype, there are some very real reasons to be excited here, and some reasons to be cautious. The biggest difference I feel in this phase of the market compared to, say, 2017 or 2021 is who's doing the buying. Back in the day, a lot of the big price surges were driven by retail FOMO, you and me, Reddit folks, people watching number go up and piling in emotionally. This time, what I'm seeing with these ETF flows is institutional money quietly at work. That's often called smart money, though institutions can be dumb too, don't get me wrong. But generally, when pensions, hedge funds, or big asset managers buy Bitcoin via an ETF, they're not looking to flip it next week. They're thinking in quarters or years. So a steady drip of institutional inflows can act like a rising tide for Bitcoin's price. It's not flashy. In the moment, you might not even notice it day by day, but it provides a kind of floor under the market. It's like having a rich uncle who quietly buys any Bitcoin you panic sell, propping up the price when others get fearful. It helps separate Bitcoin's price action from the whims of pure retail speculation. And if the price starts moving up, those same big players often buy even more. Momentum investing is a thing for them too. In short, institutional involvement can stabilize the market to some extent and also supercharge it once a real rally starts. Now, let's add another layer to this story: the broader acceptance of crypto in traditional finance, because the ETF trend isn't happening in isolation. Around the same time as these inflows, we got news that made me do a double take. Bank of America. Yes, one of the biggest banks in the world is now recommending its wealthy clients consider putting up to 4% of their portfolios into crypto. I mean, wow. A few years ago, most banks treated Bitcoin like a dirty word. Now, Boffa is basically saying, hey, a little crypto in your mix might be a good idea. That's a sea change in attitude. When an institution that big gives the green light, even a small green light like 1 to 4%, it's a strong sign that crypto has earned a more permanent spot at the investment table. And if that wasn't enough, the very next day, December 2nd, we heard Vanguard, the ultra conservative asset manager known for its index funds and generally avoiding fads, has opened up trading for crypto ETFs on its platform. Vanguard has something like 50 million clients and over $11 trillion under management. They had been staunchly anti-crypto for a long time, but they finally caved to customer demand. They're allowing trades of Bitcoin, Ethereum, XRP, and Solana ETFs on their brokerage platform. Now, to be clear, Vanguard still says they won't launch their own crypto fund, at least not yet, but the door is open for their clients to buy others. This development further bolsters market confidence because it shows even the traditional giants can't ignore crypto anymore. It's become too mainstream to exclude. So think about all these pieces together. Consistent ETF inflows, signaling institutional buy pressure, price gaining strength, major banks and asset managers warming up to crypto, and on top of that, there's a decent chance of a Federal Reserve interest rate cut in the near future, possibly later this month, December. If the Fed eases up on monetary policy, that historically has been bullish for risk assets like stocks, and Bitcoin often reacts even more dramatically to such liquidity boosts. Lower rates could weaken the dollar and push investors to seek higher returns. In assets like crypto, it's like adding fuel to an engine that's already revving. All these factors combined set the stage for what could be a perfect storm for Bitcoin. Could is the operative word. Nothing is guaranteed in this world, especially not in crypto. But you can see why some folks are genuinely optimistic that the coming weeks might be explosive in a good way. I've got to admit, I'm cautiously optimistic too. I haven't felt this mix of excitement and underlying confidence in the market's foundation in a long time. However, let me balance that enthusiasm with some practical preparation and caution, because I want you to be ready for either outcome rocket to $120,000 or a sudden pullback. One thing I've learned through years in crypto is the importance of having a plan and managing your risks. For starters, let's talk about crypto exchanges. When the market gets crazy, whether it's shooting up or crashing down, exchanges have a bad habit of going down at the worst times. It's like clockwork. A big move happens, and suddenly some exchange is temporarily offline for maintenance or freezing withdrawals. I'm not naming names here, but if you were around in previous bull runs, you know this pain. That's why I have a strategy. I sign up, complete KYC verification, and test out multiple exchanges ahead of time. Essentially, I've got plan A, plan B, plan C when it comes to trading platforms. If exchange A halts withdrawals or has a meltdown, I can quickly move to exchange B or C to manage my funds or take profits. I strongly suggest you consider doing the same. It doesn't cost anything to have an account open and ready, and it can save you a ton of stress. Just make sure to use strong passwords and two-factor authentication on each security first. Full disclosure, I have affiliate links on my website for some exchanges that I use. If you decide to sign up for a new exchange and you use my link, it's an affiliate link that supports the channel at no extra cost to you. Those links are listed on my site, linked in the description. But regardless of how you sign up, the key point is don't put all your eggs in one basket with exchanges. Spread out your risk and have backups ready. Even with multiple exchanges, though, remember that keeping crypto on exchanges long term is risky. Exchanges can be hacked, go bankrupt, get shut down by regulators, you name it. We have a saying in crypto, not your keys, not your coins. If your crypto is sitting in an exchange wallet, it's essentially in the custody of that exchange. If they freeze accounts tomorrow, you're out of luck. I sleep much better at night knowing that the majority of my crypto is secured in cold storage, meaning offline, in my own control. My go-to solution is using hardware wallets. These are small devices like a USB stick that store your private keys offline. Personally, I use ledger devices for this. When you hold your coins on a ledger, it's like having a vault in your pocket. No one can move those funds without physically having the device and knowing the passcode. Now, an important tip if you're considering a hardware wallet, always buy directly from the manufacturer. Don't be tempted by slightly cheaper prices on Amazon or eBay. There have been cases of fake hardware wallets sold by third parties that can compromise your funds. So go straight to the source for peace of mind. To make it easy, I have a direct affiliate link to Ledger on my website, link in description. Again, that's an affiliate link, so if you use it, it helps support the channel, and I genuinely appreciate that, but it also ensures you're headed to the real Ledger site. Whether you use my link or not, just double check you're on the official Ledger website before buying. This is one area where you can't be too careful. Scams are everywhere, and a fake wallet device is a nightmare you don't want to experience. Alright, so we've covered the big market picture and some safety measures. Now I want to pivot to something a bit different but pretty exciting in its own right, a sort of crypto side hustle that I've been exploring, which ties into the broader theme of how crypto is infiltrating everyday life and infrastructure. If you've been following my channel, you might have heard me mention Unity nodes before. It's one of those projects that sound a little bit like science fiction at first, using smartphones as nodes in a global network. But it's real and it's happening, and I think it's super relevant to where this industry is headed. In short, Unity Nodes is a new initiative by a partnership between Minutes Network and World Mobile. Yes, the World Mobile that's big in the Cardano community for decentralized wireless. The idea is to turn ordinary smartphones into part of a decentralized telecom network. Basically, your phone can perform small tasks like test calls, pinging networks, verifying signal quality, etc. And in doing so, it helps telecom providers with network auditing and reliability. All of this is recorded on the blockchain for transparency. And here's the fun part, you get paid in crypto for contributing this service. It's like mining, but instead of crunching meaningless numbers for proof of work, you're helping verify real-world network data. When I first heard about Unity nodes, it caught my attention as a potential passive income play and a truly innovative use of blockchain tech. So I decided to dive in personally. I acquired a Unity node license for myself, They issued these as NFTs, but think of it more like a software license or a subscription that allows you to participate. The NFT part is just how they manage the licenses on chain. My license came with the ability to connect up to 200 smartphones as nodes. Now, I'm not going to deploy 200 phones right off the bat. I'm starting with a small test batch of 10 phones to see how it goes in practice. I want to make sure the setup is smooth, the rewards come through as expected, and it's all legit before scaling up. If it proves successful, I might gradually add more devices. I mean, imagine having 200 little devices quietly earning crypto for you every day. That's the dream scenario. But I will only go there if the data from my test run looks good. I've learned to start small and scale with evidence. That's another little tip applicable to everything in crypto, from trading to trying new platforms. One aspect I really like about Unity nodes is the flexibility in rewards. The system lets operators like me running those node phones get paid in various cryptocurrencies, including Bitcoin, Ethereum, ADA, and even XRP, among others. You can choose your payout preference. Personally, I'll likely choose to earn in BTC, ETH, ADA, and XRP because those are assets I'm bullish on long term and happy to accumulate. It's like staking, but instead of locking up your coins, you're locking up, or rather utilizing, some hardware and data connectivity and getting rewarded in crypto. According to the project's info, the rewards ultimately come from real usage, like carrier fees, not just inflation or printing new tokens out of thin air. That makes it more sustainable in theory, as it's tied to an existing $2 trillion telecom industry that's being made more efficient. Now, I want to emphasize Unity nodes isn't the main focus of this video's story. Think of it as a cool side quest I'm sharing with you. It's just that in a week where we're talking about institutional ETF flows and global finance, it's pretty cool to also see crypto making moves on the grassroots level, right down to turning phones into revenue generating nodes. It shows that crypto adoption isn't just about Wall Street, it's also about real world utility and innovation on the ground. If this concept piques your interest, I encourage you to do your own research. I'll put a link in the description to Unity's light paper and their rewards calculator so you can read about how it works and what the earning potential might be. I've talked about Unity nodes in previous videos, so some of you are already in the loop. For those who aren't, don't worry, I'll keep you updated on my Unity experiment in future videos. Whether it's a smashing success or a disappointing flop, you'll hear it from me straight. And if you're curious right now, maybe check out the link below to learn more about Unity nodes and see if it's something that fits your style. It's not for everyone, but I find it fascinating. Bringing the focus back to the big picture, what's the takeaway from all of this? For me, it's that crypto is growing up and integrating everywhere from big institutional investment vehicles to the smartphones in our pockets. And as an investor or just an enthusiast, it pays to stay informed and adaptable. We're in a fast-moving space. A year ago, who would have thought we'd be casually talking about Bitcoin ETFs attracting steady inflows, or Bank of America endorsing a crypto allocation, or our phones earning crypto on a decentralized network? Things change fast, and those who stay informed reap the benefits, while those who stick to old narratives get left behind. I try to stay on top of these trends by engaging with the community. By the way, if you haven't already, feel free to join our free educational Discord, link in the description. It's a great place to hang out with like-minded crypto folks, ask questions, share news, and get insights. We've got a bunch of smart, helpful people in there every day. In fact, it was someone in our Discord who first pointed out those early ETF inflow numbers to me. The conversation there often sparks my research. So yeah, jump in if that sounds useful to you. It's free and we'd love to have you. Another resource I want to mention is something I'm personally proud of: our cheeky crypto school at cheekyschool.com. I started this online school because over the years, I've seen how many newcomers and even some veterans struggle with things like trading strategies, portfolio management, risk management, and so on. These are crucial skills if you want to survive long term in crypto, especially when the market gets wild like it might soon. So, we put together courses that teach you these skills in a structured way. It's all the stuff I wish I knew when I started, packaged neatly so you don't have to learn the hard way as I did. If you're interested in checking that out, there's a link in the description as well. And as a thank you for watching this video till the end, you can use the discount code YT50OFF to get 50% off any course. I want education to be accessible, so hopefully that helps. Again, that's YT50OFF for 50% off on cheekyschool.com. Details in the description. Whether you take a course or not, just make sure you're always learning. Crypto isn't a get-rich-quick scheme. It's a volatile journey that rewards those who take the time to understand it. Now, as we wrap up, let's reflect for a moment. Why did I tell this story, and what should you take away from it? Well, I wanted to shine a light on those quiet signals like the ETF inflows that often precede big market moves. A lot of people only pay attention to the loud headlines: Bitcoin hits new high, or crypto crashes 20%, that kind of stuff. But by the time a headline is screaming at you, the smart money has often already positioned itself. The small shifts in the market, like a few days of steady inflows, don't guarantee anything, but they hint at what could be coming. If you pay attention, you'll often catch the trend before everyone else. As of early December, those signals suggest this market is on firmer ground than past cycles. We might be close to a real breakout. Maybe that's $100,000, maybe $120,000. Maybe more. If it happens, great. If not, that's fine too. I'm not staking everything on a short-term move. I'm focused on being ready for anything: account setup, assets secured, staying informed, and diversifying what I do in crypto, including things like Unity nodes. Whether Bitcoin crosses six figures soon or takes its time, I think we're heading there eventually. The foundation is being built piece by piece: institutional interest, better infrastructure, clearer regulation, and steady innovation. It's like watching a house go up. You don't notice the progress until suddenly the structure is there. These consistent inflows feel like that slow, steady drip filling Bitcoin's reservoir of demand. Thanks for sticking with me through this breakdown. I hope it sparked some ideas on how to strengthen your own approach. If you like this mix of news, personal perspective, and practical tips, let me know. It's a style I enjoy, and I hope you do too. Crypto is a long game. Stay calm, stay sharp, and stay prepared. The next few months should be interesting. Subscribe if you want more updates, and I'll see you in the next video.